The quarterly results of Google, or Alphabet, were released on October 29th in the U.S. local time. This is the third quarter 2020 results announcement. There was an earnings release and an additional 6.45% increase in the pre-market. All the stocks were dropping in the pre-market, but only Alphabet showed a remarkable and dramatic rise. Alphabet has risen relatively less than other tech stocks, even though its stock price has risen by over 23% over the past year. Alphabet was kind of least favorite stock by investors lately. You can see that the current stock price level is the level just before the corona explodes. In the case of the Alphabet, it is a representative stock that analysts have shouted to by almost always over the past 3 years. The target price has always been higher than the current stock price, and it remains in effect today. In the previous video, I mentioned that the number one companies that investors should include among NASDAQ-listed companies are Apple and Alphabet. Still personally, I think Apple and Alphabet are the top priority companies that should always be held. The reason for this is that, first of all, both companies have clearly established themselves as platform companies, so there are no competitors in the market. In the case of Alphabet, in the search market, it is in a unique position so that it cannot be compared with the second, third-place companies. The strong market share based on Android OS and the profit structure as a platform company in the Play Store show a more stable business structure compared to other NASDAQ-listed tech companies. Not only that, but the current stock price does not seem to have a bubble compared to other stocks, but the reason it is not popular in the market, especially with Korean investors, seems to be that it is a stock that makes it difficult to make a big profit in a short period. However, it is difficult to find a stable investment destination with a strong long-term stock price increase and a solid business, but personally, it is a bit unfortunate that such companies are being pushed out of the ranking of investment items. Let's briefly look at the results this quarter. As you can see just before, Alphabet's stock price surged on its own in the pre-market's downtrend after the performance announcement. And the reason for this is, of course, an earnings surprise that far exceeded expectations. The reason why the stock price soared is, of course, because the EPS linked to the stock price exceeded our expectations. The EPS estimate was $11.29, which was a whopping $16.40. Sales were also expected to be $42.9 billion, but as we reached $46.2 billion, almost 10% of the surprise came out. Google Cloud's sales also exceeded expectations, and Untitled sales exceeded expectations by 15%. Traffic acquisition costs were briefly mentioned in the previous video, Apple's earnings video, which is what Google pays to other companies like Apple, in exchange for allowing traffic to flow into its search engine, which was higher than expected. Even though the TAC came out higher than expected, the fact that the EPS was so high can certainly be interpreted as a testament to the fact that this Alphabet's performance is really pretty well across all business units. Looking at the ad revenue, which is the main source of sales of Alphabet, it declined in the second quarter, but this time it turned back to growth. The biggest contributor to the increase in ad sales is YouTube ad sales. It increased by 32% compared to the same period last year, and as there are certainly many people at home, the number of people watching YouTube, like those who are watching my video now, has increased. The overall business, structure, and company analysis video of Alphabet is linked in the explanation section at the bottom of the video I uploaded last time. If you want to know the overall aspect of the Alphabet, please refer to it. Since this video is a brief overview of only this performance, I will not explain the business divisions separately. So, let's take a look at the earning release material of the Alphabet. First of all, it explained that the increase in sales and the earnings surprise was based on the growth of advertisers' spending on search engines and YouTube, as well as the growth of Google Cloud and Google Play. As you can see, net profit grew 62% while we compared to the same period last year. Sales grew by 14%, but if you see that EPS grew by 62%, you should be able to get a feel for Alphabet's sales, costs, and profit structure. You can see why the Alphabet has to be a great company. If you look closely at the Alphabet's income statement, you can understand it. The Alphabet is not an ordinary manufacturer. If a company based on the general manufacturing industry basically has sales, there is a certain level of cost of sales in proportion to it, and accordingly, sales profits come out. Also, operating expense proportional to sales is generated, and operating profit is calculated accordingly, and net profit is calculated. In short, the cost is somewhat proportional to sales. But the Alphabet is not a manufacturer. Of course, they sell hardware like Pixel, but Alphabet is, of course, a platform company and a software-based company. Here, it is not an exaggeration to say that when sales reach a certain level, the sales generated after that are almost taken as profits. Costs and sales are not completely proportional. Costs are also divided into fixed and variable costs when they go deeper into the cost accounting level. Google's costs are more of a fixed cost than a variable cost. In an easy analogy, if there is a company that makes video lectures, if that company costs $1 million to make video lectures, the cost is over with $1 million. If there are more than $1 million sales, the excess sales are mostly just net profit. Of course, Alphabet has a large cost structure called TAC, which is somewhat proportional to sales. And of course there are costs that move in proportion to sales. If you're simply analogy, it's good to know this concept to understand the Alphabet's profit structure. For example, comparing the performance in the same period of 2019 and 2020. If sales increased by roughly $6 billion, the cost of sales increased by only $3.5 billion. The cost of sales increased at a much smaller rate than the increase in sales. In addition, R&D costs are almost the same. Sales and marketing costs have decreased, and G&A costs show almost the same value. Compared to the increase in sales, many of the key costs have increased much less or little. So, the increase in sales contributed to the increase in net profit to a large extent, and this caused the EPS to skyrocket. No matter how economies of scale are achieved in general manufacturers, it is impossible to have a profit or loss structure like this. I will wrap up this video like this. I am trying to upload the performances of major companies as close as possible from the performance announcement date. But it takes time to make each video, so please understand that there is a slight lag. Next, we will see you soon with a video about the Facebook performance announcement. Thank you for watching the video.